Let me level set. The reason I think 2025 is the biggest macro shift since the gold standard is I got to take you back to 1971. And in 1971, the dollar went fully synthetic. That was the year that Nixon ended the convertibility of dollars into gold. Now think about that for a moment. In 1971, the dollar no longer represented anything except another dollar or a promise to repay.
If you want to understand why Tom Lee calls this the best opportunity of his lifetime, start with that frame. He's not pitching a trade so much as locating a hinge in monetary history and then mapping today onto it. In his telling, 2025 mirrors 1971, when a structural rupture forced Wall Street to invent new rails to keep the dollar supreme. Today, those rails are being rebuilt on public blockchains, and Lee's thesis is that investors who recognize the rhyme will be positioned where the new plumbing creates outsized value.
And when we think about that, most people said, well, gold was the trade in 1971. That's true, but it wasn't really the big opportunity. In 1971, the financial system had to suddenly think of ways to make sure the dollar remained dominant, because if the dollar wasn't convertible into gold, another currency could be dominant. And so what Wall Street did was they created a huge market for the dollar. Money market funds, futures, debit cards, mortgage-backed securities, currency swaps, interest rate swaps, index futures, zero coupon, CDOs, etc.
Lee reframes the lesson of the 1970s. The fortune wasn't only in gold, it was in the financialization that followed. The instruments and rails became the business. That's the lens he applies to crypto's next phase, where policy, capital markets, and software collide to manufacture a new transaction layer. If the past is prologue, the winners are the builders of the rails and the assets that sit at their core.
And in the US, the groundwork was laid with the Genius Act, which set the stage for a stablecoin boom. And then the SEC launched Project Crypto, which is moving Wall Street onto the blockchain. And there, of course, are two other pieces of legislation underway in Washington. One is the Clarity Act, and the other is the Bitcoin Strategic Reserve Bill.
Policy momentum is part of his conviction stack. Whether those names are headlines or harbingers, the direction of travel is clear in his view. Tokenize dollars, migrate market structure, and let the capital follow compliance. For investors, that suggests a regime where scale players get green lights to bring trillions on-chain, compressing costs, and expanding addressable markets.
And so that's why Bitcoin, of course, remains the OG in our view, because you now have a digital store of value. But I think you want to think about the other side of that ledger. What is Wall Street going to do? And in our view, Wall Street is going to play a very significant role in creating a market for digital assets. And in our view, the biggest winner here is Ethereum.
Here, Lee splits the thesis in two. Bitcoin as store of value gravity, Ethereum as transaction fabric. The former anchors narrative and reserves, the latter powers rails and cash flows. This is where his lifetime opportunity line starts to sound less like hyperbole and more like a barbell designed for a decade of market structure change.
If gold today is at 4,000 per ounce, and maybe it'll get to 5,000 per ounce, well, we want to think about what Bitcoin to gold ratio is. What percentage of Bitcoin's network value should mirror that of gold? And if it's only at 10%, then you get a $140,000 value for Bitcoin. I think that number is too low. I think it's going to basically match gold's value or even exceed it. And that's how you get to the $1.4 to $2.2 million of value per Bitcoin.
His Bitcoin math is simple on purpose. Pick a North Star, then argue parity. It's provocative because it translates an abstract digital gold meme into a concrete range. Even if you haircut those figures, the takeaway is magnitude, not precision. And it sets up the second prong of his case, where he believes the building, and therefore the compounding, happens.
And part of the story arc is, and we've already seen it, is that we're talking about stablecoins, which is tokenized dollars. So that's almost like the 1971 moment. But we're talking about tokenized equities, tokenizing credit, real estate, reputation, and eventually intellectual property. All things that are measured in the economy today. And I think there's going to be invisible measures that get monetized on the blockchain. Data collection, royalty payments, loyalty programs, agentic AI, and even important things like proof of human.
This is the Rails thesis in practice. Take what markets already price, then tokenize, settle faster, and instrument the previously uninstrumentable. If that happens at scale, the platforms that host it accrue value the way exchanges, networks, and operating systems have historically. Lee thinks that means dollar dominance migrates natively to chain, and the numbers, in his telling, already hint why.
And you might wonder, why does the US government care about stablecoins? Well, it's the same reason the US cared about the synthetic dollar staying strong. Today, the US dollar is 27% of GDP, but it's 57% of central bank reserves. That 57% shows you that Wall Street's efforts to make the dollar the standard of transactions after 1971 was effective. It's 88% of financial market trades, okay? But it's basically 100% of stablecoin denomination.
If stablecoins are just dollars with APIs, then policy support is geopolitics by other means. Lee's argument is that tokenized dollars entrench the greenback by making it programmable and ubiquitous. For investors, that channels liquidity toward the chains where those tokens live and the companies that can monetize the flow.
Tether is 50% bigger than Bank of America, and Bank of America is a giant.